Welcome to the Capital Spreads weekly update. Today is Wednesday the 9th of March 2011 and today marks the second anniversary of the bull run. Obviously commenced 2 years ago on the 9th of March 2009, and what any of us would have done to have bought a lot of the stocks in the FTSE 100, or for that matter across many global indices at that time. The FTSE is up over 70%. Many other global indices have doubled since then, so it's been a very, very impressive bull run, and some 2 years historically would suggest that we're only halfway through a bull run. Bull runs do tend to last around 4 years, but of course that doesn't mean that this one will last a similar length of time. So at the moment the FTSE continues to languish below 6,000. It's at 59.50 at the moment. The Dow some 1.5% off its highs at 12,200, and on the currencies the euro-dollar has just rejected the 1.4000 level, and it's at 139.00. Cable is a little bit weaker as well at 162.00, and gold is below its all-time highs. It's around 14.30. Oil, very topical obviously at the moment. It's just ticked a bit higher today. It's at 114.50, and that's the main focus of the time at the moment. The price of oil. We were higher in earlier trade in the FTSE, but we've come off a bit as oil has rallied, and OPEC trying their best to allay concerns over supply by saying that they will match any shortfall in supply, but it hasn't really brought down oil as much as people would hope. And that is the major factor that is preventing the markets from moving higher at the moment. So for the FTSE, it's very much focus on the 6,050, 6,100 area. Can we break above there? If not, to the downside, again, 5850, 5800, they're the major support levels. And a break below there would almost certainly, could very possibly bring us lower towards the sort of 5500 level. So how are clients trading at the moment? Well, they're long the FTSE and they're long European indices, expecting us to possibly test those resistance levels. But conversely, on the US markets, the S&P in particular, they're quite short. So feeling that the US markets, which had a very good day yesterday, have got further to retrace. They remain short euro-dollar, feeling that that 1.4 level is too far, too much for the euro, and especially since we've seen a reemergence of the concerns over the sovereign debt crisis in Europe. The euro has just weakened over the last couple of days. Clients remain long gold, and also they are still long crude. For the rest of the week, the focus will very much be on tomorrow's Bank of England interest rate, where again the sentiment is expected to perhaps shift a little bit more hawkish. The bank really has to move at some point quite soon in order to look like it's doing something regards the high inflation, and certainly a few more members are joining the rate hike camp. But what they are fearing is that any movement by them will possibly drive us back into a recession, and we could see a double-dip recession. So they're probably going to wait until the end of April when we get our first reading of GDP numbers for Q1 before they actually make a decision to hike rates. But there is pressure to the hawk camp, people shifting that way, and in particular Europe. We saw a very, very big signal last week that the ECB will raise rates very, very soon. Then on Friday we've got retail sales from the US and also the Michigan confidence as well, so that'll be a focal point for Friday. The theme of this week, well, very much a case of where are the markets going. I've got a chart here, and believe it or not, it's a chart of the FTSE, which I've actually inverted. It's a weekly chart over quite a long time frame, and what I'm trying to illustrate here is often it's quite a good thing to look at a chart that's been inverted to sort of get a different angle on things. And it looks like this market is set to fall further, i.e. rise further. but that doesn't necessarily mean it's the case at all. But what is interesting is that the move so far over the past 2 years has retraced us to the 23.6 Fibonacci level. So that's why there's a lot of resistance around here. Again, you've got the psychological 6,000 level, you've got the unrest in the Middle East and North Africa, and that's all contributing to making it very difficult for the markets pushing higher. That's it for this week. As ever, do give us feedback, media@capitalspreads.com.